No, this isn't a shitcoin that rugged on the crypto world. This is one of the strongest currency the world has ever known and is called the British pound. In this video, I'm going to show you just how unsustainable the UK economy and monetary policy has become and talk about how you can make money from this crazy time. So to trace back to where it all began, we need to look at the beginning of mankind. Nah, I'm just kidding. Let's just start with the super high inflation. I'm hoping you know what has caused that, and if you don't know, let me know in the comments and I can make another video on this. But to start us off, US basically suffered from a super high inflation, and to tackle this head on, the US government decided to reduce the amount of money in circulation by what is called quantitative tightening and increasing the interest rates. Personally, I'm not so sure if that effort is working to reduce the inflation. Only time will tell, and we need to keep an eye on inflation data, but the world has seen this, and because the US was the first to move, the relative low supply of the US dollars has caused the exchange rate of almost every other country's currency in the world to plummet. And so that is what you are seeing here in the United Kingdom. In fact, whilst the UK is in the spotlight, you can see that just about every other currency is breaking down against the dollar. But UK is especially more in trouble because of the following. UK is in a time of massive inflation. Because of the war in Ukraine, the food prices have soared by a record 10.6% this month. Costs of staples such as margarine, pasta, tinned tomatoes have reached new highs. Now, what's worrying is that these are staple prices that are growing, which means inflation is hitting inelastic demand, which is really, really bad. Think about a scenario with a loaf of bread between 3 people versus a Porsche. If the prices of goods rise, then you don't have to buy that expensive Porsche, but just because the prices rise, it doesn't mean you don't get to eat and all is good. So in this scenario, we call the demand for bread, which is a necessity, inelastic demand, where more luxury items like Porsche would be associated with elastic demand. The lingering war in Ukraine is also a contributing factor, as energy prices are impacted to produce these staple foods, which drive up the price. And to tackle this inflation issue, the best way the world knows how is quantitative tightening, which will reduce the supply of pound sterling, which introduces the increase in interest rates. Traders are now pricing the interest rate hikes by the Bank of England to more than 200 basis points of increases by the next meeting in November. Now, this is a very steep increase in rates, one that even beats Paul Volcker's daring moves in the 70-80s. Some are expecting that the interest rates will triple by next year. And this is causing what I would call a reasonably rational fear in the markets, with people afraid of losing their homes due to higher repayments on their mortgages. Now, this is probably a necessary play in reducing the money supply of the pound, which will increase the value of the pound against other currencies. And this is super important because UK is a net importer as a country. UK's imports in the quarter of June 2022 was 206.6 billion pounds, where the exports sat at 178.6 billion pounds. And when the pound is worth less, the cost of importing goods from overseas goes up, as UK has to rake up more pounds to pay the same value for their imports. Yet this endeavor is invalidated by quantitative easing at the same time. Yep, that's right, you heard that right. They are reducing money supply and increasing money supply at the same time. They are quantitative tightening and easing at the same time. No, they're not doing this because they're stupid. They're doing this because they have to. When you increase interest rates, then the first market to suffer, other than your mum and dad homeowners, is the bond markets. When the interest rates rise, the investors dump UK bonds for 2 reasons. The pound sterling is crashing, so there is no point for foreign investors to keep UK bonds. And the increasing rates means that there is a higher risk in the short term, so investors will want to pull their money out. So what does UK do? To stop the sell-off, the government goes to buy back the bonds to boost demand for them. Buying back 65 billion pounds of bonds is exactly the definition of quantitative easing, as conceptually the government prints more money to then be able to afford the buyback of the bonds being sold off by investors. So this is a quick fix, but the issue is going to be worse because too much printing was what gave rise to the falling pound sterling in the first place, which then led to increasing rates. And then the dangerously high rate was going to destabilize the national economy by breaking its bond markets, and that's likely going to repeat. But there's even more money printing in the horizon. The Chancellor, Kwasi Kwarteng, has announced 45 billion pounds of tax cuts, which was apparently necessary to reshape the UK economy. Now, I'm not here disagreeing that the tax cuts were helpful or not, but I don't think it was conducive to a long-term solution to a perpetually enlarging inflation issue. So this tug of war between QT and QE is really just putting more tension in the economy and really taking a step forward just to take 2 steps backwards again. So how does knowing all this help? How can you make some money out of this? Well, let's look at the chart like EWU, the iShares MSCI United Kingdom ETF. Now, I personally see a support around that 20 mark, and with a bit more to go, that might be the region that the chart might test again. And from a fundamental and technical point of view, this does seem like a reasonable level of support. But do keep an eye on the markets during that time. What policies is the UK government coming up with, and does the monetary policy line up to boost the economy? So here is the big empire cycle as explained by Ray Dalio from his book Changing World Order. Ray Dalio's concept of the big cycle scans through the last 500 years to show how big cycles play out before examining more closely the declines of large empires and their reserve currencies. So let's have a look at this diagram. Look at what gave rise to the rising of a kingdom, and look at what contributes to the decline. You will notice from number 13, it starts with larger debts. Check. Printing more money. Check. 15 and 16 is kind of happening at the same time. 17 is lurking on the horizon, and we don't want 18, but it might just be coming.